And so one of the most important questions that we ask people, and I tend to talk to men more than females first. I'll say, hey, genuine question. If you were not here tomorrow, how much of your income would you want to go to your family forever? And they all say the same thing, as much as possible, as long as possible. So that starts the conversation. And I've yet to interact with our ideal prospect that has said anything other than, oh, I just need to rethink my thinking on this and start prioritizing that everything's not about cost.
Well, it's a misconception a lot of times, because when you're dealing with life insurance and people have a general understanding of how premiums work, they think, oh, I'll start a policy on my kids because it's cheaper. Well, that doesn't translate to the life insurance world in the way that you think it does when it comes to whole life insurance and everything like that. And so it's really important that they understand that you have to solve at the U level first to the greatest of your ability before we start looking outside of that.
When I know as a husband and a provider and a business owner, as an entrepreneur who's always out and about trying to create value in the world, that I can bet on myself. And even if I swing and miss and I get to go to the pearly gates because I know I get to see Jesus, but if I know that there's no financial burden being left to my family, or said another way, there's going to be a financial windfall, I am more inclined to live life with more peace of mind and be more creative and be more active and be more engaged and be more thoughtful, because I've already protected the fact that I can't predict everything.
Welcome to the Cashflow Legendz podcast with your hosts Nate, Brandon, and Brock. Remember, our insights are not direct financial advice, so consult with your financial team before making any decisions based on the topics discussed in this show.
Welcome back to Cashflow Legendz. Nate and Brock and I are here to talk about something that you don't hear talked about a lot, but we're excited to kind of dive into it from our many years of experience. Is this topic today, I think a lot of people avoid, guys, because they don't really know how to properly mesh it into an overall financial plan for somebody, especially if they're teaching them about whole life. So we're going to be talking about kids policies, or as the insurance industry calls them, juvenile policies is what they often call them. And that means anybody under the age of 18, so correct. 17 and below. And the main thing we want to focus on today, guys, is just being sure that people understand that there's a place for them always, because it's going to make whatever you're doing in your household more efficient. But there is often an order of operations that may need to be followed depending on where you are currently and who's insured in your house and who the main income earners are and those kind of things. So let's start out with just a simple question of, Brock, how many times do you hear conversations about kids policies, or is it more of an afterthought that you circle back to?
A lot of times it's an afterthought. Most of the time people will come in and they will talk about a policy on them. Then they'll learn all the benefits and they'll say, well, what if I just did it on my kids? Yep. And that's typically when it comes up. And then we have to redirect the conversation a little bit to say, hey, we need to do it on you first, and then we can move to the kids. Because what a lot of people, and I'm sure we'll get into this in a second, is they think, oh, let's just fund the kids. But in the overall scheme of things and how planning works, or you would want it to work, is hopefully your death benefit would fund your family trust, and the family trust would then begin helping fund your kids' policies.
Nate, how often in your front side conversations, because Nate typically in our company with ULC does a ton of front side interaction, how many times does the kid policy question come up for you mostly?
Well, it's a misconception a lot of times, because when you're dealing with life insurance and people have a general understanding of how premiums work, they think, oh, I'll start a policy on my kids because it's cheaper. Well, that doesn't translate to the life insurance world in the way that you think it does when it comes to whole life insurance and everything like that. And so it's really important that they understand that you have to solve at the U level first to the greatest of your ability before we start looking outside of that.
Let's touch on that U level real quick, because I've been having that conversation a lot lately. And when I ask somebody, hey, do you know how much income you're going to produce over your lifetime and how that gets calculated by an insurance company? I've yet to have anybody, unless they have insurance background of any kind, even really knows what that is. Somebody will be like, I think this, but for the most part, most people don't know. So it's simply, what are you currently earning in income multiplied by how many years are you till you're 60 or 65, depending on the company roughly. So if I'm 30 and I make $100,000 a year, and I've got 35 years till I retire traditionally, 65, that's 100,000 times 35, which is $3.5 million. I said this yesterday, congratulations, you're a millionaire. Now do you want to protect it? Now do you want to use it to your benefit? Now, it's not that cut and dry always. There's a lot of other variables that can come into play. How much insurance you already have, how much premium you can pay. There's variables that protect the industry to be sure they don't ever let us get out over our skis for their benefit also. But when you start with that whole idea of, like Nate said, can I start with my kid because it'll be cheaper? That's a real good indicator that there's still some education that's needed, right? So Brock, if you've heard that before, or when you hear that, how do you help kind of frame out starting at the U level? And I sometimes call it the top of the waterfall.
Yeah, I think a lot of it comes to the fact that it's kind of like the plane.
Yep.
Put your oxygen mask on first. And what a lot of people don't think about, I believe, is when you think through wealth building and providing for your kids, most people think, oh, well, I just need to set money aside for my kid to do this thing at this point in time. Well, when you think that way, not only do you remove assets, capital for your retirement income, but what you also do is you neglect the fact that if you do the best job at creating the most amount of wealth for you, that will automatically pour into your kids' lives and be able to fund more. Because a lot of people don't, we were talking about this the other day with a family where this guy has been putting so much money into his 529 plans for so many years for his kids, not realizing that when they go to use this money, it's going to cost him, he might have 250 grand in the accounts, but it's going to cost him over $1 million in retirement income. Because once that money's spent, it's gone. They don't get that money back for retirement. And, we could get into all the other nuances about the fact of who even knows what school is going to be like in 10, 20 years. How do you know if your kid's going to get a scholarship or not? Right. So when I went to school, thankfully, my parents didn't do 529 plans. I didn't pay a single dime for school until I went to Vanderbilt. And even then, I know how to pay for it because I had the capital. But, again, there's things like, the trades. Who says your kid's not going to go to trade school because he realizes he can make, 6 figures right off the bat because nobody else is doing the work?
This is really timely because I saw a post this morning from somebody, I don't know who it was, and it was just traditional financial advice where it says, hey, if you want your kid to be a millionaire, here's what you do. When they're born, put $1,000 into the S&P and then contribute $100 a month until they're 21. Let it sit until they're 50, and then they'll be millionaires. And I'm just like, yeah, like I've already solved for that. Like, and I don't even have a 21-year-old yet. I've already solved for that. And I solved for it through the natural flow of my cash and being efficient with what I have to work with. Like, I'm not going to have to sacrifice $100 a month for all 4 of my kids for 21 years at a time to be able to make sure that they're taken care of.
Well, and Nate, I saw a post just like that, and it like irks me now because I used to read that and just eat it up.
It's also assuming at age 50, the market hasn't gotten cut in half.
It's also assuming at age 50, you're alive. It's also assuming at age 50, if this. So a lot of times when I get asked about 529s because of Brock's point, what he said earlier and what Nate just said, I'll say, would you rather guess, or let's just put it side by side and see what you taking over the process of money flow would do for you today, tomorrow, next year, 2 years from now, and see which one you like better. When you present people with an opportunity to gain more certainty and control, they now are making the decision between I'm investing and betting on myself or trusting in something outside of my control. And when they have that, they often go, oh, well, I kind of like this idea better. They just didn't know. So, Brock, I don't remember where this came from, but your dad would always say this to us, and I really like it. We have to humbly meet people where they are. That's my part of that. But he would say, and assume that they are doing the best they can with the present level of thinking that they have.
All the time.
All the time. So the real question is, hey, if we could show you a better way with no pressure other than learning, is that worthwhile to you to explore? That makes it easy on everybody. If they say, absolutely, let's go, then we're off to the races. If they say, no, I want to keep doing what I'm doing, okay, we're happy you're doing what you're doing, if you're happy with it. But I know go ahead, Nate.
My bad.
You good?
I was just gonna say, since you brought up Trent, it reminded me of something else that ties back to what we just said, where we're talking about all these assumptions in the traditional way that people operate in terms of funding a child's investment strategy, as opposed to matching up a guaranteed event with a guaranteed contract. Now we have a predictable outcome that we can operate in. And we have certainty that's already built into the equation, so that we're not having to hope, because hope is not a financial strategy. We don't have to hope that it's going to work out the way everybody said it's going to work out.
There's a key. So, Brock, you were showing us earlier something really cool before we hit record. You were showing us a first edition, Becoming Your Own Banker, that Nelson Nash signed for your dad, and then the 5th edition. And the thing that I am fascinated by that is just the coolness of it first. It's just unbelievable. But there's yes, sir.
There it is.
Man.
First edition.
Nice paper
with a handwritten note from Nelson to your dad, and just some really cool stuff.
Yep.
That's so cool. Nelson gives an example. I don't know if he did it in that one, but in the 5th edition, about how you would be better off with more certainty and control by funding a policy for your children, assuming you've already solved at the U level, at the top of the waterfall. And he talks about just this reality of, we get to teach our kids the process of banking as they're expanding their system and we're funding those policies. But you can still use it as a investment mindset of, like, we're just going to set this away till they're ready to use it. It's just not an investment like the traditional sense that it's locked away, because it's going to create cash value. It's going to create the ability to utilize it. For all my kids' policies, we've utilized them over and over again. And it's just getting to the point to where I can let my 15-year-old think about, I have this much cash value. I'm about to work out a deal with purchasing my first vehicle for my grandfather. How can that all work together to allow him to be in control of the flow of money? And he's already figured it out. He's like, the faster I do work to pay him back, the faster I can use the money again. Absolutely. And so the biggest piece of all of this is taking over the function of banking, slow and steady with long range thinking, and starting at the you and me level. So, Nate and Brock, sometimes we get the pleasure of meeting with people who have a very close-knit family. And let's say they're young and spry like Brock, and they've got parents that are only in their 50s. And I go, hey, Brock, do you think your parents are on board with exploring this learning opportunity and having some comparison? He goes, absolutely. We've already been talking about it. Well, that's a great opportunity to bring them in the fold, because they're above him in the waterfall, as we say. And anything they do is just going to make what he's doing better for his generation and the next. So talk about that a little bit, about when I say waterfall, maybe different ways y'all describe that, but starting wherever we can on that ladder, if you will.
I think there's a lot to unpack there.
Yep.
But whenever I'm doing larger cases or family cases, one of the things that I like to talk about is the fact that if you are somebody who is inclined to be family generational planning, you got to think of it like the Golden Gate Bridge, right? it can't be, I'm starting on one side and I'm just going to build to the next, because there's going to be so many things that go off. What I like to do is you want to build both sides of the bridge first and then be able to connect them in the middle, like they did with the Golden Gate Bridge. I think one of the best books that describes that, and where I learned it from, is a place called Entrusted by my good friend Andrew Howell. He works with a lot of my clients. And when you get to that standpoint, what you really want to be able to do is, there's G1, right? This is your, let's say, mom and dad. That is who you focus on first, because G1 is probably much further along than me. Like in my life, my dad produces more than I do, and he has for a very long time. So he has more assets than I do. Well, if we take care of him first and life continues on and I continue to work the best that I can, the day that they die, which has to happen, unfortunately, that wealth will then be passed on to me and my brothers. And then we have to become good stewards of that, to which we can reflect back on other things like the family constitutions or family retreats or family meetings to build out that wealth for us so that it continues on. Because a lot of things that people don't know, maybe they do know, but if you looked at family wealth, typically the money goes hot by the third generation, meaning all the wealth is completely gone. 90% of family wealth is destroyed by the third generation. So mom and dad, they pass away, they pass on the wealth to G2. G2 typically spends 70% of it or more, and then G3 gets what's left over and then it's gone. And you have to start this cycle over again. And, something that my dad says is, if the only reason that you buy life insurance is to get back the taxes that you paid throughout all the years into your family's life, that could be the best reason. Because what a lot of people don't understand is the fact that you losing $1 million to your kids and not giving that to them can cost your grandkids $500 million or great grandkids, right? Because of the fact that they didn't have that capital in their life. And then that brings up the conversation, which we might get into here in a minute, which is, well, I don't want to make trust fund babies.
Yep.
I don't want to have my kids be trust fund babies. Well, guess whose fault it is if they become trust fund babies? It's yours, because you didn't take the time to set aside quality time with your kids to show how you create wealth. What are your values? What are your mission? What is your vision to push this thing forward? And I'll shut up now, but I think there's a lot.
Nate, you have anything you want to add before I go into two things that jump into my mind?
I'm gonna try to say this without getting choked up. My youngest son, their basketball team, their coach encouraged their players to go through an exercise recently, and it was like the 4-H exercise or 5-H or whatever. And I don't remember all the H's, but the ones that I do remember was a heartache, your biggest heartache. What is your heritage, and who is your hero? And my son, for heritage, he wrote that I have a Christ following family. And man, I was just like, Lord, what did I do to this? Like, of all the times that I thought I just screwed up royally, the fact that he gets that just meant so much to me. And then I can't talk about it, but he lists me as his hero and why, but I won't be able to get through that.
So Nate, I'll take over before you start tearing up, because I already knew this story, so I've already teared up once, so I can handle it better this time. So y'all heard Brock say something about G1 or G2, Generation 1, Generation 2, Generation 3. Fascinating story. And Brock, I don't even think I've told you this. I told Nate. So I played baseball in Puerto Rico for a week, a little over a week ago. And one of the guys on my team, we get to visiting, and he's using language that I've heard that most guys on the team are not familiar with. And I start responding back to him, and we're like, "What do you do?" And I tell him what I do, and he's like, "I do something very similar." I said, "Well, tell me what it is." So he basically is the COO, if you will, of a family office that has 500 employees. And I said, what do you spend the majority of your time doing? And he's with G3. He said, I spend the majority of my time with the 40-year-olds in G3, teaching them how to create a heritage to continue to perpetuate their wealth. And I said, how much insurance do you buy a year? He goes, you wouldn't believe it if I told you. And so for those who've never heard the family office term, let's bring it back to the you and me level. When Brock talks about his dad or the oldest generation having more assets and being sure that they're protected, you're not only buying death benefit for the purpose of death, you can use the cash and the capital in it for the purpose of living. So what Brock's doing in his life can combine with what his parents are doing, can actually make the flow of money more efficient for the things you need in your life, business ventures, purchases of anything that you're going to use to control the repayment terms. The list goes on, expansion. But I really want to circle back to what Brock said about heritage and what Nate said. When you don't want to create a trust fund, baby, you are basically saying, I don't want to be the best version of myself for my family that I can be. Because the reality is that a trust can be set up in a way to protect your kids from themselves, and they can know that while you're living. And a heritage is left based off of how we capitalize in our relationship with them while we're on this earth. Now, if one of them turns into a knucklehead, the trust can just be set up to where they can't get access to it until they get right and get back on the right path. Yep. So I always say, as compared to what? Having to have a GoFundMe because you pass away and you leave them dead? I mean, where do we want to stop here? And yeah. I think that's an important question to ask, as compared to what?
Well, Brock doesn't have kids, but I know for a fact that all three of our parents have policies on us.
Yep.
And so, that's, we're speaking from both sides of this thing as for me and Brandon as parents, but also as kids who have parents who have policies on us. So all three of us can speak from that experience of the cool value of what that means, because not only is that something that our parents get to utilize now and get to benefit from, but eventually it's going to be something that my kids get to benefit from.
And to me, as a parent, and having my parents involved and my in-laws involved at such a deep level, the peace of mind to know that we can all bet on ourselves and our creativity because we have more certainty and control, because we know there is going to be a waterfall of dollars that are directly related to our skill sets and our abilities over our lifetime, allows my parents and Nate's parents to live life in a way that they love and not have to go, oh, if I go on this trip, my kids may not get to experience this because I have to choose between the two. And this is relevant in every single conversation that we have with anybody that's with kids or grandkids. It always comes back to, oh, so you're telling me I can live life on purpose in this season of life, and I can pass down all that value that I created upon my death? And now they're like, okay, this is way bigger than just I'm buying some death benefit and paying a premium. But we have to be willing to unlearn. So Nate and I were on a call yesterday with a couple in their early 50s, and they are tired of doing the things the way they've been told to do because it's not getting them to where they want to go. That's clear. So they recognize they're going to have to think long range. And when you say that to a 51 or 52-year-old, that can often freak them out. Because in their mind, because the world is so fast-paced, they think long range means I need to think till I'm 130. And I'm like, no. We just need to think in 3 to 5 year spurts and think and work backwards, because this money's leaving your life right now and you're not getting any benefit from it. Let's just start creating a system where you feel like you're taking 2 steps back, but you're basically just reaffirming up your foundation so you can now take 100 forward. And when the wife said, so you're telling me when I take these 2 steps back that my family is protected for if the worst case happens, and I'm taking off this earth early, and I can make my and my husband's life more efficient as we do this for the next 30, 40 years of our go to slow-go years. I was like, that's exactly what I'm saying. She goes, why wouldn't everybody do this?
So something that's rattling through my head is you were just talking about taking 2 steps back. Number one, it's funny that you say that because last night I was driving home, I was on the interstate, and I'm thinking, for some odd reason, why does it make sense for us to slow down to be able to speed up? And so I'm in the far right lane, merging on. Well, there's an 18-wheeler on my left, and there's an 18-wheeler right in front of me. So there is nowhere I can go except for slow down to then get over and then pass. And oftentimes can't, people just think, oh, we have to just keep going forward. We have to just keep going forward to realize, you might be going forward, but it's a sucky path. Like your path sucks and you need to change. And that might just mean you got to take a couple steps back. Right. So that's what I think about that. But it's something I think we need often. We're really good at. Here's our subject. We talk about this all the time. Here's our subject. And then we kind of get off path. So
We do.
let me get back to kid policies. And here are the broad main reasons for it. Number one, on the death benefit, we're not talking about like a Gerber or State Farm policy where it's like, oh, you're getting $50,000 of death benefit and we're going to pay $10 a month into this policy. No, this is a policy where you are intentional about it. And it's not uncommon where your kids are going to have over $1 million of death benefit. Now, with that, the caveat has to be the kids can only have up to, depending on the company, 75% of what you, the owner, have in death benefit. So if you have $1 million in death benefit, each kid can have up to $750,000 of death benefit. What that does for them, if you acquire the whole life insurance for your kids, is the fact that they are now insured for the rest of their life, no matter what happens in their world.
Yep.
If they get sick, if they get hurt, no matter what, they will always have that guaranteed protection that will last for the rest of their life. That's number one. Number two is the fact that now you are building a asset for them, that you're saving money in this policy by transferring premiums into it, and you're building this cash value. Well, this cash value, again, can be used for anything that you want. But one of the best things in the world about these is the fact that they do not count against the government programs. So if you're a parent, you probably know what the FAFSA is. Or if you're young like me, you probably know what the FAFSA is because you just had to fill it out not too long ago. What that FAFSA is, I think it's like financial aid, federal aid, something. But basically the premise is, hey, fill this out for the government so we can know how well you did so that we can give money to the other people that might need it. Well, even if you did like a suboptimal job and you saved all of your money into retirement plans, brokerage accounts, UGMAs, maybe I said 529 plans, Coverdales, whatever it is, all of that goes on that FAFSA for them to see, oh, wow, you did a good job. We're not going to give your kid any financial aid. Well, that asset that you build in whole life insurance with your kids doesn't count. It doesn't go on that because it's a private asset. So you may have all of this capital within your policy that you don't have to report so that your kid may be able to get some more financial aid. And at the end of the day, it's probably more you're the one that's getting the financial aid because those first couple of years, you're probably paying for it.
Yeah, if you want some of your tax money back, that's a great way to get it.
Yep.
Yeah.
Absolutely. And then the last thing I'll say on this, and maybe we can dive more into this, is this becomes one of the greatest teaching tools around finances you could ever think about.
Absolutely.
Your kid wants a car, guess what? You can show them how to have a loan that you set the payment terms up on. You show how it works. And if they miss or mess up, guess what? You get to make the penalties, not the bank, which ruins their credit for a very long time.
Yes.
They want to buy a toy or something early in their years. All right. Show them how it happens. Show them how it works. You take the policy, you buy it, you pay it back. These are things that you are able to teach your kids without penalties or without disrupting the growth on the asset. So I think this by far is one of the most powerful assets you can own, not only on yourself, but for your kids to be able to teach them financial literacy.
So I was working with a business owner who owns a successful construction company, and we're talking about kids policies just this past week. And I said, and we were talking about sort of the difference between letting them go do it on their own versus creating your own banking system. And I said, one of the things that I think about is when we have a family banking system, now we get to introduce elements of grace, love, and mercy into the equation, which you don't get by operating with a bank where you're just a number on a screen. And so, yeah, if there are situations where life happens, and we've had situations in our lives where life happens, and you don't get a whole lot of grace with a bank. There's not a lot of mercy or a lot of love that comes out of that process. But when you're doing family banking and you have kids who are really trying and really working hard to do well, and life happens and it throws them off for a minute, hey, guess what? There's grace, mercy, and love now.
And if you're already inclined to help your children, would you want to help them build a foundational approach on the front side that's more stable, or help them recover from being committed to something that they had over their skis and they have to deal with that side of things like financing or bank loans or credit card debt or whatever? If you're going to help your children either way, why not have a foundation that can really allow them to start understanding that, hey, if you nail this piece in your personal life, and then in the person that the Lord has aligned you to marry, if you get married, y'all can start building those things out before you get married. You will already move yourself up the ladder on likelihood of success in marriage because you know how to communicate about money. Period. No questions asked. Because I see it every day in all my conversations. Hey, how well do you and your wife or you and your husband communicate about money? Yes, we have those intimate conversations. Because if you and her are on different islands, I am not getting in the middle of that. But if you're willing to come together and go, hey, maybe there is something better, then life starts happening more efficiently, even when it doesn't go according to plan, because you're on the same page. And that's a key piece that I love about what we do, Nate, is when husband and wife start communicating about money well, even if it's uncomfortable, they immediately have better traction and more grace because they're like, hey, we're on the same page. This is important. And that is a huge deal that most of the world does not experience. I see it every day. And that's really why I always say, yeah, we teach about money, but it really isn't hardly ever about money first. It's about behavior, mindset, and relationships.
Well, and that's a huge win for us when we get to see behind the scenes families coming together around this conversation and how they start to become more united in what they're doing. Like you and I, we get to celebrate those things, time and time again, which is so much fun.
Brock, I'm curious, you work with a lot of entrepreneurs that are younger. So do you have entrepreneurs that are, 25, 30, maybe newly married, and this question about kids policies comes up? Or is it kind of something you bring up just because it's not on their radar if they have kids?
If they have kids, sometimes, yeah, but it's more of the fact that they learned how it works in their own life, and then they think they can get around it by adding it to their kids.
Yep.
And I oftentimes would say, hey, you first. Once you have if you still want to put money aside for your kids, then we start there.
Yeah.
Right?
And there's some real cool feature on kids policies also that you can protect their ability to get more insurance in the future.
Yeah.
And that's really cool too, because I know multiple people. We have one in our family, our next to youngest, who cannot get insured because of his heart. And the only way we could have gotten him insured is if we would have had all paperwork ready and done it within the first 5 days of his life. And I don't even know if you can do that timeline wise, because you got to get the Social Security card. And so it's like 2 to 4 weeks, I think, typically is the fastest you could do it, from my knowledge. Brock, does that sound right for you?
Yep. So 14 days.
14 days. Okay. And so he couldn't have gotten insured no matter what we wanted to do. And like unless there's something out there that I don't know about or we don't know about.
Yeah.
And that's in my household, and I have conversations like that over and over again. So let's touch on this real quick. Ooh, I really don't love the idea of getting death benefit on my child. And I'll say, hey, I get that, but let's really lean into why you feel that way. As compared to what? Not having it, and God forbid the worst thing happens ever, and you have to bury your child and there's not any death benefit. That's a huge multiple of what you put into it. Not any compared to being able to teach them how to be great stewards. It's in alignment with your heart and what the Lord calls y'all to do with your money. I mean, you can keep going with those questions if somebody's invited you to ask them genuinely. And it doesn't take long where they go, oh, this is more than just about death benefit.
Yeah. And I think another thing that we have to think about is the fact that I might nerd out here for a second. Most people don't, their reality of death is so skewed. Like, oh, well, we could die tomorrow, but we don't want the death benefit. Oh, he's going to live a long time. Oh, but we could die. Like, the reality is you could die tomorrow. But, I've started to study mortality as in like actuarial science and how it works.
You are a nerd.
Thank you. I don't number one, what they have found is people who have money live longer and want to live longer. Number two, if you have insurance, you tend to live a lot longer. Why? Because, the insurance companies know what's going to happen. And if you looked at like a chart, I don't know anything about charts or what they're called or anything, but if you looked at a graph of mortality, you would see that it is super flat for a very long time. And then it starts to go up just a little bit. And we were looking at one just the other day. I think it was standard rating or preferred rating. I don't remember. But there was less than a 10% probability. So less than a 10% probability that you and your spouse would be dead by 70.
Yep.
No, I know that we've lost at least one classmate so far that I know of. I don't know. I don't know if we've had any more. But it was a totally freak, unexpected thing. He wasn't sick.
Exactly.
Yep.
What happened very simply is he saw some kids who were drowning and he jumped in to save them. He ended up drowning in the process.
Yeah. Yep. And I think that's what a lot of people forget. Like, yeah, you're going to have death benefit on this, but you are buying this as an asset for them for their future.
That's right.
Well, I can speak from experience of losing my dad that a death benefit gives you permission to grieve better.
And it's become more and more clear in my conversations and for me. And Brock, you said this, I'm going to say it a different way because I really like this point. When I know as a husband and a provider and a business owner, as an entrepreneur who's always out and about trying to create value in the world, that I can bet on myself. And even if I swing and miss and I get to go to the pearly gates because I know I get to see Jesus. But if I know that there's no financial burden being left in my family, or said another way, there's going to be a financial windfall, I am more inclined to live life with more peace of mind and be more creative and be more active and be more engaged and be more thoughtful, because I've already protected the fact that I can't predict everything, period. And so one of the most important questions that we ask people, and I tend to talk to men more than females first. I'll say, hey, genuine question. If you were not here tomorrow, how much of your income would you want to go to your family? Forever. And they all say the same thing. As much as possible, as long as possible. And then I'll say, okay, well, what if you're still here, but you can't produce income? And they're like, oh, you mean being disabled? Yep. Well, as much as possible, as long as possible. So that starts the conversation. And I've yet to interact with our ideal prospect that has said anything other than, oh, I just need to rethink my thinking on this and start prioritizing that everything's not about cost. It's about what value, what peace of mind, and how do I fit it into what I'm doing. And maybe I give up something for a little while because I get the peace of mind of reprioritizing my dollars. And then it goes to the kids from there, which is where all this started. Because any household that is wanting to leave a great heritage, these things are already on their mind. They just haven't been introduced to the possibility of doing it in a more efficient way. Are we saying 529 plans are bad? No. Are we saying all those other things Brock mentioned are bad? No. But we are saying, what if you had the ability to compare one to the other, and you could list out what gives you what options compared to the other options and decide which one's better for you? That is a different deal. Brock, I see that smirk on your face. Tell me what's trolling through your head.
I think we're good.
Okay.
Hey, what works for your family? That's what we'll say.
That's right. That's right.
So here's some guidelines to think about if you're somebody who wants to implement policies for your kids. So number one, you got to have life insurance on you, the adult, the owner of the policy. Okay. Number two is if you have more than one kid, either your death benefit or your premiums have to be somewhat relative, right? You can't give one kid $10,000 a year and another one $2,000 a year. Like they have to be relative either on death benefit or premium amount.
Yep.
The other things that you want to think about is, this isn't going to be like a $5, $10, $20 plan. Like if you're already setting aside, $1,000, $2,000, $5,000 for your children, go for it. For our business owner clients, those of you who utilize the tax strategy as it pertains to paying for or paying your kids on your payroll to help reduce. In no way is this tax advice. Please don't take this from me. But what we see a lot of people do is they will pay their children so that they reduce their taxes. The children will have an income that is tax free. To then those parents will typically, what we see is put that money in a Roth, to which I then have to challenge some thinking around what do we know about the velocity of money? Well, if I take that income that I just paid my kid and I pay it towards the Roth, that money has to then stay residing in the Roth. If I invest anything, it has to stay in the Roth. Whereas if I am in a mindset that I know more money moves, the more efficient my economy is, what if I first paid my children's salary or income to my life insurance policy? Because once I enter into the life insurance policy, that means I can then enter anywhere else in your financial life, whether that's using the cash value or the dividends from that policy. A simple way to think about it is you pay your kids, you take that, you pay towards the life insurance, and the life insurance, if it kicks off dividends, guess what? You could put that in the Roth rather than just going straight to the Roth and then being stuck.
I was talking to my 15-year-old the other day because he's about to approach his grandparents on negotiating a deal to collaborate on him taking over one of their vehicles and creating a one-page contract for value creation. And we were talking about it, and I said, would you rather $1 do one thing for you, or $1 do 3, 4, 5, 6, 7 things like Brock just described? It does not take a rocket scientist to go, no doubt, 4, 5, 6, 7, 8 things, if I can. So then that brings us to this reality, and we'll talk about this at another time, of what's really keeping us from doing something. It's normally the current thinking we have about a certain topic or product or words. Because if we just laid it all out beside each other like Brock just did, you'd be like, no brainer. I can do an IRA, I can do a Roth, and I can do all these things. Why wouldn't I pair them together? And then that little word or words whole life comes up, and people go, I heard this and this about that. So we can talk about that another time. So kids' policies are super valuable. They're a great asset while they're growing and living, to pass down the things that matter to you the most in your family, and to teach them while they're living the value of controlling the banking function. and really family banking in a lot of ways as you grow and expand your system. So guys, appreciate your time and your insight today. Everybody watching, you can always connect with us on Cashflow Legendz with a Z.com. You can book a call there. You can look at past episodes. You can leave comments, and that's a great way to connect with us. If you think that might have piqued your interest enough to talk about kids policies, just hop on our schedule. We'd love to talk to you about it. Have a great day. We'll see you on the next one.